Hi everybody, this is Thomas Wynn from Wynn Capital Management. In this video I'm going to attempt to explain how we hedge our portfolios with protective puts. The first thing I'm going to address is why don't other firms hedge? First of all, this strategy is very time consuming. Most firms don't have the expertise to do it, and there's risk of unperformance, which most firms don't want to deal with. The combination of these things make it a poor business decision for most advisors. So why do we do it? Our mission is a little bit different than other advisors. Our mission is to bring advanced trading strategies to regular clients. This is based on my past as a trader on the floor of the exchange, where large affluent investors and professional traders do a lot of things that normal investors don't do. It's hard to do these things, but that is the mission of Wynn Capital. We have the expertise in-house. This would take years and years and years for someone to develop this kind of expertise. But I learned these strategies on the floor of the exchange over 16 years, and I bring them for the benefit of my clients. We have a commitment to managing risk and driving performance. That might seem like everyone does that, but they don't. And our business model is not intended to be the most lucrative for our firm. It's intended to be the most lucrative for our clients. We think in the long run that's a good business proposition. So what does a protective put accomplish? First of all, it defines our risk. We can know with accuracy how much we can lose no matter how low the market goes. Underperformance is limited to the cost of the put. Usually it's around 10 basis points, which is 1/10 of 1%, or 50 basis points, 1/2 of 1%. So typically we put on a strategy like this for 1 week to 1 month, sometimes as long as 2 or 3 months, and we know how much we're going to underperform if this strategy doesn't help. Outperformance in down markets can be significant. If we're right and the market does decline, we can make a multiple of our risk. It reduces the amount of money we have at risk. Basically, it takes some of the money off the table. So that's what it accomplishes. We're going to dive into a case study, something that is actually still happening now with our clients and was initiated on January 14th. And the highlights of this are that on the 14th, due to many factors, we bought 600 February 172 puts. The cost for the firm as a whole or per client was about 15 basis points. And what that trade did was that it put a 6% floor underneath the entire firm and underneath each client's portfolio. What ended up happening in this particular case was we did what's called we financed the position through trading. The market did fall, and the value of the puts went up about 4 times. The cost was about 50 cents per put. These things went to about $2.30, and we traded some of them. We owned 600 and we ended up selling about 400. The average price was somewhere over $1, which means that the income that we received made the remaining puts virtually free. And in this case, which is rare, we have protection against the downside, but it's actually going to allow us to outperform no matter what the market does. Even in an up market, we made enough on this trade to give us outperformance in an up market. So we're going to dive into a few graphics, and we're going to try to see if we can explain this in greater detail. First of all, we're going to take a look at where the market was. This is a chart on your screen of the 1-year chart of the spiders. The spiders are an exchange-traded fund that we use to buy and sell and invest in the S&P 500. You can't buy the index itself, but this trading vehicle allows us to do that. And as you can see, for the past year, the S&P 500, as measured by the spiders, was in a very, very good uptrend. And so at the end of last year, we were right here. And the market as measured by the S&P, was up about 30%. Always remember that the S&P is a single asset class, just large cap US. When we don't do as well as the S&P, a lot of people question our performance. But we own large cap US. We also own mid cap, small cap, foreign and foreign emerging markets, and bonds in general, and every kind of subcategory in between. So that our performance is the aggregate of all those asset classes, not just this single one. If you would like, you could just own the S&P 500, and you would always get something close to that after expenses. But a diversified portfolio performs better over time with less volatility, and that's what we do. There are many years that the S&P is down or underperforms relative to all the other asset classes. This particular year, it was just about the best asset class out there. So having said all that, on the 14th of January, I'm highlighting the 13th right now. I know it's hard to see on the slide, but around the second week of January, my indicators said that we might want to hedge our risk a little bit. And on the 14th, I bought protective puts. Puts are a derivative, and they allow us to put a floor underneath our portfolio, which I did. The floor was around the 172 area, about 6% below the current market price. So after you put on a position like this, basically the firm and all the clients in the firm on their stock positions can only lose 6%. And if the market goes down further than that in a sudden fashion, we will be protected against that. And our puts will increase in value at the same rate that our portfolio is declining. Sounds like magic, but that is just how it operates. So we can see here that after the 14th, the market did decline sharply. And the value of that put did increase. And during this decline, I took some profits in that, removing some of our risk protection in an effort to finance the risk protection. Eventually, I left about half of the position on, and I locked in profits on about half of the position, and the market went up, and here we are, and this is a real time today on the 13th of January. So I'm going to take a look and see if I can explain this graphically in another way too. This graphic now on the screen is software called ThinkPipes from TD Ameritrade, and what is on the screen is a P&L chart. This is the way we look at our portfolios. Not very many firms have the ability to look at the value of their portfolio in real time, second by second, and make adjustments if necessary. But in our case, I have put into this graph ownership for the firm of about 55,000 shares of the spiders. I've converted the entire firm to a spider position so we can look at it that way instead of the diversified way that we've look at our portfolios. This chart describes that if the firm, what the firm makes if the market goes up, and what the firm loses if the market goes down. And here I've asked it to calculate on a 20% rise, the firm makes about 1.8 million, and that's spread out among the clients, of course, prorated according to their size. And if it goes down, it's linear. This is how all portfolios look if they're not hedged. You're going to make a certain amount if it goes down, you're going to lose a certain amount, and in general, portfolios rise and fall with the general market if you don't do anything. And you can see here that it shows these numbers. Now, if I add the put position to this, you'll see graphically what happens to the position. And what happens is on the left side, instead of losing 1.8 million like you would if you had a linear position on, you can see that around the area about 172 we have what's called curvature. This is what advanced traders do all the time. They put a small position on that is like a little insurance policy, and it starts increasing in value at the same rate that the portfolio is declining, and you can see that our risk flattens out and tops out at about $562,000. That's the max loss in case there was a catastrophic decline in the market. Now, this strategy was a 6-week strategy. We have about 2 weeks left. And it's still on, and about 36% of the portfolio is still hedged. But this is about the best I can do on trying to graphically show what's happening with your portfolios. If you think about rounding these numbers to $1 million account and you have a 6% floor, it really means that only $60,000 out of the $1 million is at risk. And if the market rises like it did in the fourth quarter, 5 or 6%, we capture all of the rise except for the cost of the put, which remember was about 15 basis points. So we capture like 99% of the rally last quarter, while only having about 10% of our money at risk. And when you think about it, if you make a 5% move on $1 million, it's a $50,000 increase. If you only have $60,000 at risk during that period and you make $50,000, your risk-adjusted return is some crazy number, close to 100%. So that is an attempt to describe what's happening. Very difficult to understand, and I'll be making more passes at this as we go. But I'm just going to skip ahead to the conclusion now, which is, if I can get the slide up. Here we are. So the conclusion is, protective puts allow us to capture most of the upside while avoiding large declines. It's much more efficient than selling shares and raising cash. You can imagine if we had taken 90% of our capital off the table because we thought the market would go. If we're wrong and the market rises, you miss out on 90% of the appreciation, and you will probably get fired by your clients. This is a way where you only lose the amount that you've invested in the puts, in our case 15 basis points. And the guaranteed benefit is that you've got lower risk. You might not see that on the performance report because despite having lower risk for 6 weeks, the market might not go down enough to make the put valuable, and it can go out worthless, and you can underperform by 15 basis points. But despite the performance, you do have lower risk during that whole period, and that is a huge benefit. The potential benefit, if the market falls, is huge. It can be very significant, and in the past we've had good luck during declining markets hedging with puts. There's no guarantee, of course, that we can do that, but we always make the attempt. And as I mentioned, the downside is slight underperformance. And that's about it. I hope you find the material helpful, and if you do, please like our pages and share this link with your friends. That's all I've got to say on this at the moment. Thanks a lot for listening. Bye-bye.